Is now a bad time to invest? JP Morgan Chase CEO Jamie Dimon said, we still have geopolitical conflict going on. Ukraine war is causing all kinds of problems in the food and gas and energy prices globally. We have inflation that remains rampant, and we have uncertainty over how high interest rates will actually go. Combine that with a waning consumer confidence, and we're headed for potentially some really rough times. So naturally, investors are looking for more and more safe investments where they can grow their money and hopefully not lose it. Now that brings us to the topic of today's discussion. We're going to be talking about preferred equity. Preferred equity is a unique strategy that is typically only available to those in the institutional world. It is a combination of debt and equity. It's almost a hybrid of debt and equity. Now, what does this mean for you? That means that this type of investment has only 75% of the return of being an actual equity investor, but it decreases the risk by over 1/3. So that is what is very compelling to a lot of especially high net worth individuals that have a lot of capital and they're not looking to lose their money, but they're actually looking to get gains. So preferred equity might be right down your path. So in this video, we're going to talk about what preferred equity is, the advantages, the disadvantages, and whether it might be the right call for you considering the very uncertain economic times ahead. Hey guys, welcome back to the channel. I'm Dr. Jonny Walker. I'm a successful endodontist as well as a self-made multimillionaire in real estate. I founded a capital firm in 2019, which helps dentists and busy professionals reach financial freedom through passive investment in real estate. Investing heavily in real estate over the last 13 years has allowed me to take a giant step back from my clinical practice to a very fulfilling part-time hours, spend enormous amounts of time with my family, raising my children, traveling, and doing what I most like to do, which is investing in real estate and helping people just like you get started. All right, so what exactly is preferred equity? Preferred equity is a much lower risk investment than common equity. It provides a very favorable risk-adjusted return, especially during times of economic uncertainty. And that may be very, very valuable in today's uncertain economic environment. Now, before we can understand what preferred equity is, we got to understand what common equity is. This is the part that sits above debt. So if you're not familiar with what a capital stack is, I did a whole video on that. I suggest you click on the link. If you don't understand what a capital stack is, this might make this video a little bit easier, but I'm going to kind of summarize it anyway. Say you buy a $1 million building and you borrow $700,000. Okay, this is called debt. All right, so let's take a $1 million building. In this example, if we buy a $1 million building, this is the capital stack. $700,000 for that building will come from borrowing from the bank. That's called debt. The other $300,000 for this investment will come from what's called equity or common equity. Now, common equity is what the investors actually invest. So say an investor puts $300,000 of capital down, that will be the equity. We'll borrow $700,000 from the bank, and then we'll buy this $1 million building. This is called a capital stack. So in this scenario, the person closest to the bottom gets the money first. So if we sell this property for $1.1 million, for example, first thing that gets paid is the debt. We have to pay off this $700,000. Then with the remaining $400,000, we got to pay off the equity investor, gets their $300,000 back. And now we have a profit of $100,000. So in terms of safety, the person on the debt side gets their money first. So they're in the safest position. These guys are in a less secure position. In this same example, we buy it for $1 million, but then we sell it for $800,000. We sell it for a $200,000 loss. Who in the capital stack will take that loss? Well, you get $800,000 on a sale. $700,000 goes to debt first. So they get their full amount of $700,000. Now that $100,000 left over, because $800,000 sale would go to common equity. So the first loss position is the common equity, because if there's a loss in the sale of the property, the one that feels it is the guy closest to the top. So now, where does preferred equity fit into this situation? All right, now let's take a second example. Okay, still a $1 million property, but the capital stack would now look like this though. We're taking a $700,000 as debt. We're borrowing $700,000 of that $1 million from the bank, but then we insert a preferred equity of $100,000 in between the common equity, which is $200K, and instead of $300K of common equity like we had in the previous example, we're taking $100,000 of preferred equity and $200,000 of common equity. Now look at the capital stack. Remember, it goes from bottom to the top. The person at the top is in a first loss position. The person at the bottom is the first paid position. So now where does the $100,000? It's preferred equity. And that goes right there. This is what we're talking about today, preferred equity. They're not typical in syndications, but we're going to start to introduce them in our offerings because it's an excellent play. Why? So now there's a buffer between the common equity and the debt called this preferred equity. Now, somebody that's sitting in this position, especially during times of uncertain times, they are in a better position because they're more likely to get paid than common equity. Because they get paid first, they must be made whole first. They must get back return of their money plus their investment, so they're in a better position than the common equity because the first money that goes out goes to debt. Got to pay the lender first. Then second, you got to pay the preferred equity investor. So they get return of all of their capital plus their preferred return, which is a set percentage. And then if there's any money remaining above that, it goes to the common equity investor. So the benefit to the preferred equity investor here is that they have a significant protection on the downside, right? Because they're going to get paid preferentially over common stock investors. So in this situation, why would anybody want to be a common equity investor? Well, there's a reason for that. So there's pros and cons to being preferred equity. So a preferred equity investor may only get a set amount of return. Say, listen, we're going to give you back all your money and we're going to give you a set return of 9% per year. So what that means is that preferred equity investor, if they invest $100,000, then they're going to get 9% per year. So they're going to make $9,000 per year for the duration of that investment, which in a syndication could be anywhere between 3 to 7 years. Okay, not too bad, right? I get paid first, and I'm getting paid a very high rate of return that is paid before anybody else gets paid. So I'm more likely to recoup my invested dollars as well as my profits. But there's always a con, right? There's always a but. So now what happens is that preferred equity investor is also capped. Their profits are at 8 or whatever it's set. If it's 8%, then they get their money back plus 8% per year, and that's it. Now, what becomes favorable for the common equity investors in this scenario is, what if that deal actually returns 18% per year instead of just 8? So what happens is now these guys, these preferred equity investors, they're only going to get 8% return instead of 18. So that extra 10% of profits that they could have got as a common equity investor, they're not getting as a preferred equity investor. And as a result, that extra money goes up into this common equity. So now common equity investors, their lowest priority, but they get the highest rate of return. That's the trade-off. Higher risk, higher rates of return. So now instead of, if now they were to get 18% at a project level, right? So they were going to get 18, say the property does very well and it produces 18% per year of returns. Now these common equity investors are not only getting 18% on their money, but they're also getting the upside that the preferred equity didn't take because they're set in their returns. So instead of taking 18%, they only took 8%. That extra 10% also goes to being split equally amongst common equity investors. So it depends where you are in your risk spectrum, how much risk you're willing to accept. So like I said, these preferred equity, you can get 75% of the returns than a common stock equity investor with only 1/3 of the risk. That risk is what is important. Where are you at your stage of career? Where are you in your stage of investing? Where are you in your risk tolerance? For some, when there's all this economic uncertainty and it's just too much turmoil going on, preferred equity may make sense. It's going to hedge you against inflation. You're still going to get excellent positive returns and a much lower risk position. For others, if they believe very much in this deal, like, hey, we're getting this deal at a steal, at a great cost basis, so that the profits are essentially built in, I'm willing to take on that risk because I believe so much in this project and I'm willing to get a much higher upside because of it. So this is a personal decision. This is a decision not to be taken lightly. And if you need help making that decision, turn towards your trusted advisors and they may be able to shed some light onto which route to go. We here at Walker Wealth, this is what we do. We help investors make these type of decisions, create strategies on how they can build financial freedom. We've been doing this for a few years now, and we've helped dozens of people get started on the path to financial freedom. If you want to be one of those people, visit us on the website below, book a call with me, join our investor club, tons of resources. We're here to help. And until next time, I'm Jonny Walker. I'll see you next time.